we build better contractors. This week, we are bringing you another ESOP webinar. The one we did last year was probably the most popular webinar we've ever done. And you might think of it as ESOP 101. Today, Bob and Mary Beth are going to take you through ESOP 201. A couple of quick housekeeping items. We will be recording the webinar. And afterwards, after a certain amount of time passes, not long, we'll have Neha email both the recording and the slides to all attendees. So you don't need to email me personally. Thank you very much. Rest assured, Neha will get things in your hands ASAP. At the top, there is a chat button across the top of your screen. If you have questions for Bob and Mary Beth, then type them in and I'll try to keep up with them. And we'll get your questions answered as soon as we possibly can. And with that, we have a ton of ground to cover. And so let me turn it over to Bob Maskill and Mary Beth Gray, our ESOP experts, and take it away.
That's you, Mary Beth.
You want me to start?
Yep.
Hi, everybody. I'm Mary Beth Gray. I am a lawyer who does a lot of M&A and ESOP work. I'm based in Philadelphia at Kleinbard. And Bob and I have worked together for a long time, structuring and completing transactions involving ESOPs, a lot of which are for construction companies. And we are delighted to have the opportunity to present to you again about some factors that might be interesting to you and influential as your clients are thinking about how to do ownership transition transactions. And if you heard our prior take on this, we're going to try to make this a little bit more detailed and give you a little bit more specificity about how the transactions would be structured. But obviously, we are available to answer any follow-along questions you have. So thanks very much for letting us chat with you about this.
I think the primary considerations that we've sprinkled in throughout this presentation really talk quite a lot about leadership and succession. And a point we're going to make is not mixing up ownership succession with management succession. I think critical to a successful transition really is structuring a transaction that provides for the most financial flexibility and considers the cash flow generation of the business. We can't use all the cash flow to finance a transaction. We've got to leave capital available for volatility and as well as growth. We're not going to talk too much about communications and culture, but we are going to delve a little bit into some of the unique issues related to pre-qual, licensing, banking, and surety throughout the program. So, Mary Beth, you can kick it off on the next deck.
Okay, thanks. Thanks, Neha. So we talked about this before. If you could go ahead one more slide, that would be great. Oh, another one. Go to slide 4. One more. Thank you. So what is an ESOP? An ESOP is an employee stock ownership plan, not an option plan. It is a qualified retirement plan under IRS rules. Its closest analog is a 401k plan. It actually works almost identically to the way a 401k plan works at a company, with the significant difference being, as the slide notes, that it can borrow money, but also that the fund, the trust fund of the plan, is invested and designed to be invested in stock of the company that sponsors the plan. So at its first moment, it is a buyer, and it's designed so that it can purchase stock from an owner or owners of a company. And once it purchases that stock goes into trust for the employees of the company and provides an ongoing financial benefit. So these transactions happen all the time. The trust is the buyer, the seller or sellers are the seller, and then when the transaction is over, that stock becomes a sometimes quite valuable employee benefit for the employees of the company, who often include the sellers of the stock in the first instance. An ESOP can own any percentage of a company. It can own 1%, it can own 100%. We're going to talk a lot in this presentation about the tax advantages of ESOPs that are unique and cannot be matched by any other buyer of stock. But when those tax advantages are at their best is when an ESOP owns 100% of a company. But that's not a requirement. An ESOP is often put in place to buy a minority percentage of stock of a company. So if we could go to the next slide, please. One thing that is a little bit difficult to understand until you sort of see it in action is that the ESOP is a trust, as we described, like a 401k trust. It is the owner of the share. So in a company where an ESOP is an owner or the owner, the cap table would show that the owner of the shares is the trust. Whether a company has 10,000 employees or 10 employees, those employees own their shares inside the trust and have a beneficial financial interest in the value of those shares. We're going to talk later on about how those shares are valued and how that value gets driven to employees, but the trust is the single shareholder. The trust votes the stock that's owned by the ESOP, except in some special major corporate transactions where the employees have a right to participate in that vote and direct the trustee about how they would like their shares to be voted. And because these are participants of an employee benefit plan, they are not entitled to receive or review company financial statements the way direct shareholders would be. They are given limited access to company information and can get access to information by their relationships with people in the company, but they're not entitled to receive that information as participants in the trust. So the shares that are held inside the trust are real shares. They're issued the way shares would be issued today to individuals, but once they're moved into the trust, they're sort of shielded in the bubble of the trust, and the activities of that asset are acted on and behaved on by the ESOP trustee, who's chosen by the board of directors. Next slide, if you don't mind. So this, as Bob said in the introduction, we think about a lot of these issues as we're doing transaction planning. So, one thing we definitely want you to take away from this presentation is that ESOPs work well in a lot of different kinds of companies. We've seen them work very well in this industry. They don't work very well in 100% of companies. And so the planning process is incredibly important. And part of that planning, obviously, is to make sure that the plan and the transaction are designed to meet the goals of whoever's making the decision to sell the shares in the first place. So the seller designs the goals. The seller will determine when to sell, how much to sell, what the hoped for purchase price is, and what the hoped for goal is of having a new owner. And all of the planning that we do for transactions helps to sort of check off those boxes and see how the seller is prioritizing the goals of that deal. So one of the first goals is, how do I sell? Who's the buyer? And the nice thing about an ESOP is that, unlike a third-party buyer, the seller sort of controls bringing the buyer to the table and asking the buyer to purchase the seller's stock at whatever price and at whatever percentage the seller is interested in transacting. So the buyer is available to the company to show up at the table and negotiate a deal. And then those terms are will be negotiated over a period of time, but the bidding begins with the seller's desire to include an ESOP as part of an ownership transition. From a seller's perspective, this transaction does what many sellers are looking to do, which is diversify personal net worth a little bit better than it currently might be if a ton of the seller's net worth is held in the value of a business. We see this a ton for family-owned businesses and founder-owned businesses, that a ton of the founder's net worth is tied up in the value of the business. And being able to bring an ESOP to the table to diversify some of that business concentration risk is a huge value to the sellers. Once that happens, the management team can stay in place exactly as it was before, unlike a sale to a third party, where the third party might have an interest in introducing its own management team or its own leadership composition. The ESOP is really a passive investor in the business in a lot of ways, and it wants to see the business being run exactly the same way as it was running before, assuming it was productive and successful. And so no change is required just because there's a new shareholder introduced into the mix. And as we're going to talk about in much more detail as we go along, the tax efficiency offered in an ESOP transaction is unmatched by other kinds of transactions. And that efficiency applies to the seller, it applies to the corporation, and it applies to the employees who have that value inside the ESOP. So we're going to talk in much more detail about that. And another factor that we're really going to lean heavily on here is how does this help companies retain, recruit, and motivate employees? A company with an ESOP offers a benefit that is significant and not offered in companies typically where the ownership is held by individuals or by a private equity fund. And here what we see is a lot of sort of mirror value where the employees are rewarded for having the equity increase in value, and the company does well, at the same time because it's driving this benefit into the hands of employees. So there's a ton of data that supports, sort of a positive comparison between companies that are owned by ESOPs and other kinds of companies. And we're going to talk about that in more detail as well. And then in particular, one more, if you don't mind, thank you. So in particular, obviously, we want to, because of your clients, we want to talk a lot about why ESOPs might be particularly helpful to companies in the construction industry. There are a ton of companies right now in the United States that are owned by people who are between the ages of 60 and 70. They're looking for buyers for their businesses. They're looking for liquidity. They're looking for a mechanism to do management transition potentially, and they're obviously looking for methods to do ownership transition. And then sometimes there's a lot of desire, obviously, to do that without losing legacy, without losing cultural attributes of the company, without losing the workforce, and to continue the business in sort of a harmonious way when sometimes an ownership transition will create a ton of disruption. So what we see, obviously, with these clients is that they have highly skilled workforce. That workforce is sometimes declining. It's hard to replace people, particularly in senior jobs, and in a very valuable business. One challenge, of course, is if the sellers want to sell, individual managers may not have personal liquidity that will permit them to buy. And so the ESOP structure is designed so that there's a leveraged buyout. The company's collateral offers the security for doing the transition, and then the people who work there will be rewarded without having to have paid directly for the stock. So this provides a way to add a significant value while you're trying at the same time to manage the other, workforce attrition issues and growth issues that a lot of construction companies are facing across the country right now. So what we see is that the reason the ESOP makes a significant difference in these companies is that it offers an additional benefit directly related to the value that the employees are adding to the business. And what the data shows is that if you take two companies, one of which is owned by an ESOP and one of which is not, the company owned by the ESOP tends to grow faster, have less turnover and fewer layoffs, and recover more quickly in the event of an overall economic downturn. So it doesn't solve those problems completely, but it adds a significant additional value for employees that helps to sort of soften the edges on just typical industry constraints, that we see in construction companies. And if you could go to the next one. So what we've seen in the deals that we've done before is that contractors have sort of a double whammy. It's harder to find buyers, and there are a lot of them who want to sell. And what ESOPs offer in those situations is a couple of things that other buyers may not be interested in. First and foremost, as we talked about, an ESOP will buy a minority interest. So where a seller is looking to have a minority level of liquidity, but is willing to continue to own the main part of the risk of the business, an ESOP is fine with that. The seller can use the ESOP to sell 30% of the business, for example, get some liquidity for that value, and then continue to own the 70%, which will drive value both to employees and to the person who continues to own it. The company pays the entire amount of the benefit that goes into the ESOP. And that benefit, as we talked about, is tied to the company's long-term success. And this often provides a very specific recruitment and retention tool for employees at all levels of skill. So at the base level of employees, and then for the more senior levels of management, who again may not have the personal capital that would permit them to buy equity directly, but gives them a direct stake in the equity value of the business as the business grows. And then what the ESOP sometimes permits is a more orderly transition plan. So there's nothing that requires the business to do something significant one day. So what we often see when a business is bought by a third party is everything about the business changes immediately overnight, right? You have new ownership, you have new governance, you have new leadership, you have a new board, you sometimes have new senior management. And so the company is making a ton of changes all at once. In an ESOP transition, we see none of that. There's an ownership transition where there's kind of a orderly, quiet, behind the scenes transition of ownership into the ESOP trust. The company still runs the way it always was. The board stays the same. The senior management team stays the same. And the company continues to operate with the same external characteristics, the same brand, the same name, the same clients, the same work structure, and the same culture. And so the ESOP is intended and does in many, many instances sort of reinforce those cultural strengths of the business while doing a transition of ownership that gives some liquidity to the seller. So just to reinforce on if you could go one more slide, please. We're going to talk about the timing of this and the planning for this. This is going to be a theme throughout. It does take time. Having people who kind of, know what they're doing and have done it before is critical to the process. And most importantly, I think it takes time for the seller to understand, where do I want this to end? What do I see this looking like for me the day after the deal is over? And what are my other alternatives for a sale? And the ESOP won't solve 100% of those goals. No other transaction will solve 100% of those goals. So the planning process should help the seller sort of eliminate certain paths, reinforce other paths, and then create enough time in planning so that the end of the transaction looks and feels exactly the way the seller was intending it to go. So we now go to the next section, which is sort of a little bit more detail on the financial aspects of this, which Bob is going to explain.
Yeah, I'd like to start out with a couple real basic important elements in the ESOP for contractors and construction companies. We look at these businesses a little bit differently than the rank and file business, and primarily because of some of the complexity and the volatility of the business. And when we're going through the planning process, ultimately what we're looking at is the financial impact on the company's profitability, financial strength, and cash flow after the transaction. And when we're doing that, we need to make certain that whatever capital is being deployed to buy out the owner's stock leaves enough capital beyond that to account for growth, which costs money and requires capital, but also volatility, a bad project that hits the company at the wrong time. And so really, when looking at a financial forecast and a model to make these assessments, we've got to be as focused on potential downturns as well as growth. The other element of this that's critical is the valuation. In the ESOP world, the trustee is not allowed to pay more than fair market value or to sell ESOP stock for less than fair market value. And almost by definition, that's going to imply a conservative valuation. When we talk with owners that are looking to squeeze the last nickel out of the business and wring every single dollar out, it's a bad start, because a high valuation is going to put more stress on the business in terms of cash flow usage for the transaction, which, all things being equal, means there's less capital to absorb volatility or growth. And so there's got to be a balance between the valuation, the transaction, and the company's wherewithal to make it all work. The last point, and one of the last differences that we see in construction ESOPs, is how the deals are financed. And while in many transactions we'll try and use as much outside financing and capital as possible, that's not our strategy generally with ESOPs. Generally speaking, we like to take a conservative amount of, say, bank debt and fill in the balance of the transaction with seller notes that ultimately gets refinanced out by the senior banker and cash quickly as well. But we're not starting with that large fixed charge that would come along with a fully bank financed deal. And so by looking at a financial model that's conservative and accounts for growth and downturns, by having a conservative valuation and a correct capital structure, meaning not all financed with outside capital, we create flexibility for the business to withstand disruptions and succeed over time. Next slide, please. Again. Okay, so one of the things that we want to talk about pre-transaction and post-transaction is the accounting rules for leveraged ESOPs, and they're not intuitive. We know that bankers and sureties are really keen on a few different metrics, in particular working capital and net worth. And because of the way GAAP accounting works, any money borrowed by a corporation to finance an ESOP transaction is booked as a liability to the corporation, but not an asset. It's recorded as a contra equity account, which I'll show you in a moment. And that has the effect of putting the entire transaction on the right side of the balance sheet. So if you think about it, if we're going to put $5 million of debt on the right side of the balance sheet, and we want our balance sheet to balance without changing the asset side, then we've got to take a reduction of 5 million in the equity section to make sure our balance sheet balances. And essentially what the accountants are saying is, look, this is a compensation benefit that you're going to be giving out over time, and therefore it's a reduction to earnings. So we're going to take that all up front, which frankly is a little silly, since when that account looks the worst from a net worth perspective, it is the most meaningless, which is to say that when that $5 million is booked against equity, if you'd go ahead and go to the next slide, none of those shares are actually put into the employee accounts. And what Mary Beth didn't mention early on is that even though the ESOP buys a block of stock today and may own 100% of the business, those shares are not put into the employee's accounts immediately. They're put into those employee accounts over a fairly long period of time. And think about your home mortgage. You know, you own the house, but really the bank owns the house until you pay for it. And similarly with the ESOP is going to buy this stock. And over time, as the corporation funds a contribution to the plan, the ESOP is going to take that contribution and repay the company to pay for some of those shares. But what I've shown
Bob
here,
and Mary Beth, we got a question here, and I think Mary Beth kind of answered, but I think the question might be a little different. So Nick Thiessen asks, is there any correlation? And I think what he means is the performance of ESOP companies. In other words, does a 30% ESOP company tend to outperform a 50%, which outperforms a 75% ESOP company over time? Is there any data that shows the financial performance of ESOP versus non-ESOP construction companies?
well, that latter question is different than the former question you asked. We don't have any data that says, does a 35% ESOP underperform or overperform a 50% ESOP? At least not that I've ever seen, Mary Beth. I think you could intuitively say we're using more cash in the 50% deal that's not being used in the business, which may impact growth, but there's never been a study in that regard. As it relates to a non-ESOP company compared to a broad-based employee-owned company, there is very definitive analysis that suggests not only a greater return on assets, but a faster growth rate. And I think it's intuitive to say if everybody's got a stake in the game, they might be a little bit more interested in making it happen.
Excellent.
Yeah, and
Thank you, Bob.
I would say, yeah, and I would just add to that when we talk about the benefit, a lot of what we're talking about is the tax benefit. So a partial ESOP has tax benefits, but pro rata compared to the ownership. The most tax efficient company is 100% ESOP owned company. The performance and cultural benefits of an ESOP, it stands to reason, exist almost regardless of the percentage of ownership. But the more employees sort of feel, I'm in an ESOP owned company, and that's a meaningful part of the way this company operates, the more what we see in the data is that there's more of a return between that ownership structure and the way the company performs. So a 2% ESOP is not going to offer a meaningful enough benefit that people, I think, are really motivated by it. Once you get to 30% and above, it's it gets much bigger. I mean, there are companies like Wawa being among them. For those of you who are in the Northeast, Wawa's a 30% ESOP company. There's significant value being driven to their 30% ESOP. So depending on the size of the company, it can make a big difference.
Excellent point, Mary Beth. Thank you. So when we look at this balance sheet, what we're showing is, number one, in 2024, there is no ESOP, right? This is company running along as normal. In 2025, the company has borrowed $9.5 million, which is marked in green, both in the combination of senior debt and seller notes and a AAA note. We won't go into that, but that's another seller note. Instead of booking an asset, you'll notice up top, the asset side isn't changing, but the net equity side is. And so you see our book value is $3.3 million. We've taken some of the earnings out via this AAA number, but then was also booked against that the balance of the inside loan, just over 9 million, and our net worth has gone from 6.5 million to minus 5.6. This is the issue that really gets a lot of attention. Next slide, please. So now that we've illustrated, we're going to talk about some different solutions, potential solutions to fixing that. So one of the ways that corporations manage this particular issue is by creating a holding company, which would sponsor the ESOP, and then keep the operating company, the company that actually pounds the nails and pours the concrete and does everything else, underneath it. And by doing that, the holding company would book this contra equity account, and the operating company would maintain the financial reality of the operating business. So if you'll go to the next slide, we have a little bit more of an illustration. So what I didn't highlight, unfortunately, on this slide is I want to start out by explaining that on the left side, we've got this structure, which is the holding company, and on the right side, we've got the operating company. Now, there are lots of ESOPs with many operating companies, and so it makes sense to show the operating company as the entity that is either trying to qualify for a job, looking for surety, or looking for lending. And so the first thing I'll point out is in these two scenarios, and it's a little difficult to see, the working capital doesn't change at all. If you look at the current assets less the current liabilities on the holding company side, there is a de minimis difference between that and the operating company. And so from a working capital perspective, regardless of whether you have a holding company or not, the working capital really doesn't change at all. But what does change is the booking of the debt and the contra equity account. And you'll notice at the holding company level, just like on the prior slide, we've illustrated the new debt that's coming into the business and the accounting for the ESOP in this balance sheet. And in this particular balance sheet, it's called retained deficit as opposed to unearned ESOP shares. But that is the impact of the ESOP transaction, and the book values dropping to 4.9 million. Whereas the operating company is going to have the same working capital, as I've said before, but we're not showing the impact of the contra equity account at the operating level. This really makes more sense because the obligation to buy the stock back doesn't exist yet. It only exists as the ESOP pays for the stock and allocates the shares. And so this is a common strategy for showing the true financial position of the operating company. Now, we're not trying to mislead anybody. We talk with the sureties once we have our plan together about exactly what both of these financial statements look like. But the key point here is, especially from a pre-qual perspective, is that we're not showing the impact of the leverage and the contra equity account at the operating company level. Next slide.
Bob, can I just add a note to that? So, we at the time these deals get done, there's often sort of a, call it like maybe even 4-party negotiation. You have the trustee who's trying to figure out what the value of the business is. If there's senior financing that's going to be involved in the deal, the bank is trying to figure out what this company looks like when it's over and assess the collateral position. The seller, if their seller's financing, is doing a similar analysis to the bank, although obviously the seller is used to taking risk in the business and is a little bit more nimble about evaluating it. And then you have the surety. So there's a lot of discussion about sort of the all of the financial covenants and the real effective net worth of the business after closing. And as Bob is showing on this balance sheet, the ESOP, because of the weird non-intuitive accounting, requires you to present the financial statements in a particular way, but they show this weirdly negative picture of what the company looks like after closing, because in fact the cash flows should be the same as they are before closing. And if you add the fact that the company is not paying taxes or paying less in taxes, that can be an additive to cash flow. So a lot of this is about presentation. A lot of it is really understanding what the line items look like. And Bob and I have heard accountants say that they're willing to kind of write in a line item, kind of a special note that describes what it really is. And that holding company, operating company comparison is an effort to do that, to really kind of clarify what the company looks like from an operating cash flow perspective when the deal is over.
Excellent point. So we'll go on to talk about some of these specific tax benefits, and really there are two that we want to focus on, one for the seller and obviously one for the corporation. For the sellers are able to indefinitely defer their capital gain taxes if they follow certain rules. And this is analogous to a 1031 property exchange. So in your own mind's eye, just imagine that in that analogy, we're swapping one property for another, and therefore we're deferring the gain until we liquidate that second property. In this 1042 example, it's much the same thing. The owner realizes capital from the transaction. They go ahead and they reinvest it into what's called qualified replacement property, which are basically stocks and bonds of typically publicly traded securities. And as long as that portfolio is in place, that cap gain is deferred indefinitely. There are a couple rules related to that. We're not going to go into a ton of detail here, but at the time of the transaction, the company has to be taxed as a C corporation, which means the S corporation would have to revoke that if that made sense. And that's an analysis unto itself. The ESOP has to own at least 30% of the stock, and the owner has to reinvest that money into QRP, we call it. Now, if you think about it, the owner is typically going to go ahead and reinvest that money anyway. So this isn't so much of a constraint, although there are a couple constraints in that regard. But that are the fundamentals. And so long as that owner has that portfolio in place, that capital gain tax is deferred. And if that portfolio is in place at the time of death, there's a step up in basis, the capital gain tax goes away, and that portfolio can be liquidated. So it's fairly efficient from a taxation perspective under those particular circumstances. Next slide, please.
Hey, Bob, before you go on,
before we get there, to say that, Wayne.
Our friend Vic has a couple good questions. Who guarantees the payment of the bank debt, and who signs the surety indemnity agreement?
Well, the corporation the guarantee is going to be based primarily on the corporation's cash flow and collateral. In contractors, it's not unusual that there's got to be credit support, or, which is to say, a limited personal guarantee. But that's oftentimes where we start talking about, well, how much bank debt do you want versus seller debt? And oftentimes what we'll end up doing is we'll end up borrowing the amount of senior debt that doesn't require any kind of PG, and fill in the balance with the seller note, which, since it's subordinated, obviously doesn't require that. As it relates to the surety agreement, again, not every owner is on that guarantee. I think to the extent that it is, we've got to have discussions with who's going to take over that responsibility beyond that. Now, if the owners are staying with the business, which is oftentimes the sellers are oftentimes staying with the business, it's easier to schedule a reduction of their exposure over time. And if we need to, bring in the successor managers, leaders to take on that burden.
Got it.
And can we go back and just answer? There was another question about whether there's a strategy for the post leverage period if you have a leveraged ESOP and then the shares have all been allocated. So the answer to that is that could be ESOP 301. There's a whole lot of guidance and philosophies about how to make that post leverage period work. But yes, you are correct that we are frequently talking about the difference between the ESOP having borrowed money, and so the shares are being allocated in a relationship to the repayment of that loan, or it's a contributory ESOP and the company just contributes shares to provide that benefit. Both are possible. All of that goes back to the planning, strategy and tax goals and other ownership goals. And yes, there are lots of ways that companies manage kind of that post leverage period to continue to drive value and new shares into the hands of employees. ESOP's been around for 50 years now. And so there are companies that have been ESOPs for 50 years and they've gone through this cycle for decades where the shares are all in the bucket, the shares change hands inside the bucket, old employees get bought out, new employees get new shares, and there are lots of different strategies for making that work in a way that works for the company's particular intentions and goals.
And Mary Beth, there's another question from our friend David Jacobson out at Bay Cities on the West Coast. And David, the first part of the question is easy. Travelers is making this webinar possible, so that should tell you something about how sureties view ESOPs these days. And then the other question might be something that you'd want to talk to Mary Beth and Bob about separately, because the way you structure the ESOP is how you structure the ESOP has the main impact on, what your balance sheet looks like, which reflects, what bonding you're eligible for. So you might have some very specific questions you'd like for them to take offline there.
And believe me, there are lots of different structures that we use to accommodate the various requirements of the sellers and the companies. At the end of the day, the company is what we focus on. We want the transaction to work for the sellers, but it has to work for the company, because over the long term, the only way the owners get paid out is if the company succeeds, and the only way the employees get their benefit is if the company succeeds. So we have to focus centrally on the health of the business without creating too much burden to put undue risk on the business. That's my little homily. So I introduced this notion of qualified replacement property. This is discussing exactly what it is. I want to get on to the next slide to talk about where and why it is this 1042 transaction makes such a difference in transactions. Now, what I've done here is I've ginned up a transaction that talks about a sale of a business for $25 million and the different ways the C corporation can do it. They can sell assets, they can sell stock, or they can sell it to an ESOP and make this 1042 election. And what we've done here is, using a number of assumptions that are listed below, is we've tried to tally what the tax burden is of these different transaction sorts so that you can see, yeah, you may go to your country club and brag about your $25 million sale, but what you really know is what you end up keeping. And in an asset sale for a C corporation, it's the biggest hit. In our example, the owner is ultimately netting $15.5 million. If they sell stock, they do better. It's an $18.7 million yield. And if they sell it to the ESOP, it's a $25 million yield. And so you can see that the impact of taxation on how a business is sold is very important. And if you go on to the next slide, and we can say, well, almost a better way to look at this is to say, well, what do we want to net, right? And if you start with what you want to net, you can get to the sale price required. So in the asset sale, if we say, listen, we want to net 25 million after we pay the corporate taxes, the recapture, and the individual taxes, we've got to sell this business for 41 million. If we want to net an equivalent stock sale and pay cap gain taxes, we've got to sell it for 33.7. And if we want to sell it in an ESOP in a 1042 deal, we need 25 million. Now ask yourself, what's easier to finance, a $41 million sale or a $25 million sale to net the same thing? And that really is where this really can be a substantial benefit to the corporation in terms of the amount of capital it needs. The other thing I'll say about this is, and we've been in a situation where the boards of directors have said, well, maybe we want to sell third party and maybe we want to sell to the ESOP. We can't tell a board what the market is going to pay for the business, but we can tell them pretty closely what the ESOP can pay. And this is the slide we use to say, well, look, we have a high degree of confidence that you can get 25 million and net 25. And if you sell assets, you're going to need 41 million. Do you think you can get 64% more in the market from a third party? And that's something that the board can tangibly and reasonably discuss amongst itself to think if that's a reality or not. But we can't really say what you can get in the market. We can say what you would need to get to net this, which I think can be quite helpful to the ESOP or to the board.
And I just want to, can I just make a note about that as well? So there are a lot of the quantitative aspects, I think, of where one deal would line up compared to another deal, kind of, apples to apples, as people say. Those are real. And I think the slide that Bob just talked about is a perfect illustration. I mean, we see this in real life every day. And, as I mentioned at the beginning, one of the distinguishing characteristics of an ESOP is that, again, the seller begins the process by putting the ESOP across the table. The ESOP is agnostic about how much of a company it buys. It will pay only fair market value. But once the ESOP is there, it is likely that a transaction could get done at some price. That is far less true in the third-party sale, because in addition to the quantitative differences, the buyer has a whole other series of strategies and objectives that are going to be invisible to the seller. And the buyer may come to the table saying, we're willing to pay $41 million for your assets. But by the time the deal is over and due diligence is done, and there are holdbacks and earnouts and indemnities and escrows, that number may not be as real. And again, as we talked about, the buyer here is not looking to gain the synergies of some third-party sellers. They're not looking for a way to combine the businesses by laying people off and changing project profitability metrics and changing the way the business does its business. For construction companies that are proud of the way they do their business and they want to keep doing their business the way they've been doing it, an ESOP adds the added qualitative benefit of permitting the company to continue to operate, again, qualitatively and from a cultural basis the way it did before.
So folks, I think David's question and also Mario's, I think both of their companies are union companies. So Mario's question is, how do ESOPs work in a unionized environment, and who benefits? Is it only salaried employees, or is it all employees in a union company?
Typically.
So we can talk about, oh, sorry, Bob.
No, go ahead, Mary Beth.
Well, I was going to say, I think we can answer that question sort of along with this slide that we happen to be on at the time. So the way the ESOP
Excellent.
works for most employees is it's a company-funded benefit. The company is making the decision at the beginning, how quickly do we want shares to go into people's accounts, and what do we think that employee benefit is going to look like over a period of time. And that can be managed, but with lots of different levers that are all carefully discussed and designed at the start of the transaction. If the company, so companies are allowed to exclude, I'm sorry, let me go here. Like a 401k plan, there's a lot of testing under the IRS code about who gets covered and making sure that the plan doesn't discriminate. So by and large, the rules of the ESOP require you to include everybody. You can't include only a select group of management and have the plan continue to be qualified and get the tax benefits. So by and large, ESOP companies include all of their employees to pass the coverage tests. There are a couple of categories of employees who can be excluded at the top, and you do not have to worry about satisfying the coverage tests. Those include unionized employees, also leased employees. So companies are permitted to exclude collectively bargained employees without worrying about wrecking the compliance issues. They are, however, allowed to include unionized employees. And what we see a lot of companies do that have both unionized and non-unionized employees, a lot of them just exclude the unionized employees because they're getting their retirement benefits from another place. That's fine. It takes some communication, but that's not uncommon. Some companies will include the unionized employees and give them a discounted contribution benefit in the ESOP. so that they're not getting wildly overcompensated compared to the non-unionized employees, but everybody is sharing to some degree in the equity value of the business. So that is all part of the designing, and it's obviously very common in construction companies to have to worry about the impact on the collectively bargained folks at the time that you do the deal. So, and what I would say along with that, Mario, it looks like you have a follow-up question, is how do you calculate how much stock a person should get? That it's a great question. That's a big part of the design. Obviously, that depends on whether the ESOP, a significant factor there is whether the ESOP owns 100% of the company or a smaller percentage of the company. But the plan design and the transaction structure will tell you at the start, again, based on how much stock the company wants to put into the plan every year and based on the payroll overall, what percentage of that payroll value is going to each individual person based on the projected stock price over a long period of time. So it is a math problem that's rational, but not totally scientific in the sense that you can't just plug in the number, because the biggest factor in some ways in that number is what do we think the stock price is going to be worth? And obviously we can do a forecast of that, but we can't get it totally right. So just, oh yeah, sorry, Bob.
Yeah, there was one other question from Jason, and he's asking if if the seller gets a note, where does the money come from to reinvest the proceeds in it for within a year to realize 1042? And Jason, there is a very well-worn strategy for accomplishing that. I'd be happy to chat with that offline, but it essentially involves purchasing a security. It's a long-term floating note, highly credit rated bond whose maturity is beyond the note holder's life expectancy, that also allows for the purchase of the security for as little as 10%. So if it's a $10 million sale, 1042 sale, the buyer would purchase $10 million of these floating rate notes for $1 million. And so long as they have sufficient capital to make the margin deposit for that security, then they declare that $10 million of floating rate notes as their replacement property, and they either pay down that margin loan over time or they realize the note payments without taxation and do whatever they want with it. We can talk about that further offline if you like.
So we wanted to complete the picture because, again, one of the obviously the most influential factors in an ESOP transaction is the tax benefits that it can offer compared to another kind of buyer. So Bob talked about the real direct comparisons between a third-party buyer that's buying assets, for example, of a business versus an ESOP that's buying stock of a business. And even without the 1042, you have a big differential there in the asset sale being the asset sale being an ordinary income gain transaction typically, and the stock transaction being a capital gain transaction, which is significant. So then we get to, what happens to the employees? The employees are not charged any tax value when they receive their shares. It's an entirely company funded benefit. So as shares go into people's accounts every year, the employees see a statement, but they don't get a 1099 and it's not included on their W-2. The value of those shares may go up over time. It may go down over time, but it may go up over time. The additional value to those shares is not charged to the employee as long as those shares stay in the account. So as people get shares and the shares increase in value, they'll see in theory that account value grow over time. And only when two things happen. One, they leave the company and they decide to spend the money that comes out of the ESOP, then do they pay taxes at ordinary income rates at the time they take the distribution. Employees are not, the employees may roll over the benefit once they receive it into an IRA and continue to defer the taxes. But ultimately, once they spend the check, that's when they pay taxes. They are subject, distributions that come out before a participant turns 59 and a half are subject to the excise tax just as they are in a 401k plan. Typically what we see is that companies will keep whatever benefits they have outside of the ESOP once an ESOP goes into the mix. So they'll keep their 401k plan. They may change the match depending how generous the match was before the deal, but they'll keep they'll have health benefits, they'll keep the 401k plus the match, they'll keep car allowances and everything else, and then the ESOP is additive to those overall benefits. So if you compare two employees who have the chance to work at a company, one of which is offering them an ESOP benefit and one of which is not, there's almost always is a demonstrably more valuable employee benefit to the employee who works at an ESOP company. And then the final sort of note we want to make on the tax efficiency is that you can move ahead to the next slide. We're going to talk about the company benefit. So we even if the company is not an S corp, we're going to sort of talk about the holy grail when the company is 100% owned by an ESOP and is an S corp. But even in a company that's taxed as a C corporation, or where the company is owned only partially by the ESOP, the value to the company from a tax perspective is that there is a tax deduction to the contribution that goes into the ESOP based on the value of the shares, or based on the contribution. The company has a choice about that. So in this slide, you can see the comparison of the cost of the debt that's done for the deal. If a company bought shares back from an owner for $25 million and the company was just paying that value to the seller over time, the cost of that debt, because there's no other deduction or value that goes into it over time, would be about $29 million. If you compare that same transaction at that same value to a deal where the ESOP purchases shares from the seller, and then the ESOP is contributing those shares or allocating those shares over time to employees and receiving a contribution deduction for that allocation, you can see that the net cost of the debt in that scenario is significantly lower. So this is true without regard to the percentage that's owned by the ESOP, or whether the company is taxed as a C corp or an S corp. But the next slide shows us what most companies tend to be going for when they are doing an ESOP transaction. And that is, believe it or not, that a company that's 100% owned by an ESOP and that elects to be taxed as an S corporation, which, unless there's been some malpractice, every company that's 100% owned by an ESOP should be, the company pays no corporate income taxes. So if the company is an S corp right now and is owned by a person, let's say in New York, and that person has a 50% tax rate, most companies are using 50% of their cash flow to pay distributions to that shareholder, to permit that shareholder to pay taxes. And an ESOP, because the ESOP is not a tax-paying shareholder, that same amount can stay in the business and can be used for all of the other things that the company might need cash for, including paying distributions to ESOP participants. So over time, if everything is planned well, a company that's 100% owned by an ESOP should be building up cash over time and can use that cash to buy other companies, to pay executive compensation, to buy equipment, and to pay benefits out to ESOP participants. So it's a significant benefit, and most companies that we talk to are motivated to a significant degree by this as being the goal of the 100% ESOP ownership. And one thing I just want to note about this is, this does not, again, as we've talked about, change the ownership or leadership. So even if the company is now owned 100% by the ESOP, leadership and ownership get separated in an ESOP company. So you can have the same board of directors with some outsiders being added. You can have the same senior management team, the same CEO, and the change is that the ownership is now benefiting all of the employees at, the rate that the stock is growing, but the company is being managed and run the way it was before.
And just a little color on this. Before the law permitted the ESOP to be a shareholder of an S corporation, there were only about 30% of the ESOPs that owned more than half their businesses. And today, Mary Beth, I think the number is close to 60% of all the ESOPs own 100% of their businesses. So there has been a tectonic change as a result of this legislation. Well, as we're wrapping up here, let me just touch on a couple of the other issues and considerations. First of all, we mentioned earlier that privately held companies have to have their stock valued by an independent third-party appraiser. This is the appraiser hired by the trustee, and the trustee is the person that's ultimately, or the entity that is ultimately signing the stock purchase agreement on behalf of the trust. Now, Pilot Hill Advisors in its planning process is going to go through the same valuation process before a trustee and the appraiser are hired. We're going to go through the same valuation exercise using the accepted valuation methods, the accepted data that are being used in order to establish a reasonable range of value that we can hopefully expect the trustee to pay. There are a number of different valuation methodologies used depending on the industry. But it's important to recognize that the forecasted financial performance, which is going to be used in the income valuation methods, is going to be assessed based on the corporation's historical performance, which is not to say that the past is prologue. However, it is an indication of where the company is going. And so as owners are preparing these forecasts, you have to be mindful that an appraiser is going to say, okay, why are you doing so much better now than you were historically? And there could be a good story for that. There could be good reasons for that, but they'd have to be articulated very carefully to make certain that they're realistic. An interesting topic of discussion on valuation are prior offers. The short story on the prior offers is they're going to be ignored, because one, they're not consummated. Two, they've got to be assessed in a timely manner. They've got to be assessed as to the likelihood of success. But at the end of the day, when you look at all these factors, they can be used as a cross-check to valuation, but they're never going to be used as part of a valuation. Next slide, please. So there are a number of annual activities that happen once you have an ESOP. The trustee is going to be responsible for updating the stock. So once the ESOP owns stock, it's going to get valued every day or every year, excuse me. And the trustee is also going to be responsible for voting shares owned by the trust annually for the typical matters. That is, most importantly, for the board of directors. The board of directors each year will authorize the annual ESOP contribution. And that will ultimately be a range of contribution that they want to think about. The ESOP is going to take that contribution, and while it owes the company its note, will make a loan payment. And then lastly, there's plan administration, which is all of the accounting and allocating of shares and the compliance testing, and the ESOP's tax return will be filled out each year. This happens only once a year. And once the corporation gets into the swing of things, I think it becomes a pretty routine matter. But I think the slide that's most important really is talking about how you get from A to Z. And that is there are really two, next slide, please. There are really two phases of this exercise. One is the planning stage. That's where Mary Beth and I would be helping a corporation on the valuation, the financing structures, the percentage of stock being sold, and the impact analysis. We're also assessing the suitability for the company and the shareholders, which is kind of, hey, why ESOP and what are you trying to accomplish? We go through this exercise and ultimately make a presentation to the board with the different transaction alternatives so that they can make a thoughtful, assessment about what they want to do. This is typically a 4 to 8 week process, depending on how quickly this data can be turned around. Ultimately, after that planning process is complete, only then, if the board says, okay, let's go do this, do you actually get into the execution process itself. The first step is interviewing and hiring the ESOP trustee. The trustee ultimately is going to hire their team. There's a due diligence process. Concurrently with the due diligence process, we're going out and talking with the lending sources. Ultimately, when that due diligence process is fully baked, or at least in a good process, an offer is made to the trustee for the sale of securities. A negotiation process takes place, and we ultimately close. That process typically takes, on average, about 3 months if you're using bank financing. If it's fully seller financed, which in some circumstances it is, this process is shorter. So there's a planning process, which is all done internally by the corporation and your advisor. And then ultimately the execution process, which, includes the counterparties, which is the ESOP team. Wayne, that's it for us. The rest is just our brag sheets and our contact info.
Yeah, and that picture's got some age on it there, Bob. You didn't have any gray hair in that picture. Anyway, all right, everyone. Thanks for attending. Todd, maybe that's a question you want to take offline with Bob and Mary Beth. Their contact info. So you're going to get a copy of the slides and a copy of the recording as well, everyone. So Bob and Mary Beth's info is there. Bob, I've sent you a couple of our members' contact info by text because Jeff in particular expressed interest in that. So we'll make some connections. And if you guys have any questions, you can always send me an email here at Performance Construction Advisors. I can hook you up with Bob and Mary Beth from there, or you can just go with their contact info as you see it here. So thanks, everyone. We appreciate your time and attention, and we look forward to seeing you again soon. Thanks, everyone.
Thank you.
Thanks, everyone. Bye.